Hello, hello. Dan and Brian here. Hi, Brian.
Hello, hello. How are you doing? Happy New Year.
Happy New Year to you also. We're going to kick off the new year with a special podcast, the three do's and don'ts for the new year. And we're concentrating in on inflation, taxes, and stock market volatility. A do when it comes to inflation is really don't pay attention to all the numbers. It's not something that you can control. Worry about what you can control. We can't worry about inflation. Inflation, like real estate, is often local. So what affects one family may not affect the other. When it comes to taxes, the due is you've got time now to do an approximation, a projection of where you're going to be come April 15th. And that will give you breathing room if you're going to end up having to pay, so you don't get caught with the triple whammy. The don't is to put your head in the sand, pull your covers over, and hope mommy makes everything okay when tax time comes. When it comes to stock market volatility, the do is stick to your investment policy, which is based upon your goals and objectives, your cash flow, and your taxes. That will then create your current allocation. Then you go to the target, and it is a good time now to take a look and rebalance that. And one of the last things on the taxes that I think I forgot is that we are now getting into the home stretch of the 2017 Tax Act, the Trump tax cuts.
Yep.
Those are going to sunset, if you will, January 1, 2026. So we're now, in the seventh, eighth inning of these tax cuts. And I know Brian's been working through some scenarios. So if you could go into briefly a little detail on that, Brian, that'd be great, I think.
Yeah. I mean, I'd stick with your do's and don'ts, Dan. I think one of the big do's is have a family meeting, the multi-generational planning, because you have grandparents, parents, and now a lot of the grandparents are looking, and their kids are all of a sudden 30 years old making some good money. So, and we look at the estate taxes, and right now it's around 27.2 million for a married couple, which is a lot of money. That kind of sunsets to back down to should be around, if they don't change the law, around 14 million, which is still a lot of money. But when you take it over three levels of families, grandparents, parents, and kids, a lot of families may be running up against that level. And that was what the issue with the family down here in Florida was. So some of the do's was start planning now and start asking questions now, because, the AMT, the standard deduction, tax rates, qualified business deductions all get sunsetted at the end of 2025. So like you said, Dan, don't put your head in the sand. So when you're doing your taxes, do ask questions. Ask, am I going to be affected by the sunset provisions? Am my kids going to be affected? Or are my parents going to be affected? Those are questions you want to start asking now to get ahead of things, instead of hoping and praying that the Congress figures it out and actually rectifies, or fixes the tax code, which we all know is probably not going to happen.
That's great stuff, Brian. Like you just said, here at WMGNA, Tax Out Financial Solutions, we figure out the do's and don'ts. So anyone has any questions, you know how to get in touch with us, WMGNA.com. And, we'll talk to everyone soon.